Now I want to welcome to the stage somebody who was here last year, Constance Hunter. She got a little promotion since last year. She's now the Chief Global Economist at the Economist Intelligence Unit. And she's going to be joined on stage with Jeremy Schwarz. I know we were expecting Ricardo Mora, but we had a speaker substitution here. So Jeremy's going to fill in for Ricardo. And thank you so much for Constance for being here. And they're going to be talking about the geopolitical outlook for the U.S. and Latin America over the, well, we'll see. I guess it's the outlook. So thank you, guys.
Thanks so much.
Let me put your presentation.
Okay. We gotta load the presentation. So give us a minute. I am the Chief Economist for the Economist Intelligence Unit. And for those of you that don't know, the EIU, as we call ourselves for short, was founded just after World War II as the research arm of the Economist newspaper. The idea being that Europe had been decimated, there really weren't good data systems in place, and in order to understand what was going on in the European economies, the economists figured they would hire and develop a group of economists to engage in that work. Then over the years, we really became the B2B arm of the Economist group. Now we distribute to over 3,000 clients worldwide. We cover over 200 territories and countries. We cover economics and geopolitics. We have a number of indices that we develop. I'm gonna highlight some of those indices in this presentation and go over some data on some Latin American countries, go over some geopolitics on some Latin American countries, and just kind of set the stage for the conversation we're going to have. All right, now I'm a wanderer. I'm going to do a little test here. So if I go over here, can the people over there hear me? Yeah?
Yeah, we can.
roving?
I think this might be better for you. Yes. So we're obviously going to have this
I'll
this
try
moderation.
to wander less. How about
Right.
that?
Right.
You know, a roving mic.
Exactly.
look at that.
I think that's what you need.
There you go.
You know, one of the great things about the United States, I think, is that we are agile, right? We're agile people, we have an agile economy, we have a flexible economy, and it's that agility that I think is one of our greatest
For the
strengths.
purpose of our audience, I know there are going to be a lot of questions, and I know you have a great presentation. So to facilitate that, I'm going to step back, and how would you like to just sort of frame it, and then we just go for Q&A?
You can sit here while I talk, you can sit down in the audience and then come back
I
up,
think,
whatever you feel
I
more
think our
comfortable.
audience is going to love your presentation because it's amazing, and the natural cadence is perfect. So I think what we'll do is we'll have our staff have the mobile, some of the different microphones ready, and then once you're at that point, we can just pivot graciously into Q&A.
Wonderful.
I think that's the value of the data and the value of the analysis that you bring.
Thank
is just
you.
so high impact. And for those of you who are in the business world, I'm sure Constance's information and the analytics that she provides is really going to provide the type of value you guys are looking for your business.
Thank
so
you.
Let me step back
All right.
and begin.
All right. So I'm going to start with our U.S. forecast. And I'm starting here because, as we all know, right, the treasury markets in the U.S. are the largest in the world, the deepest, most liquid capital markets, and our 10-year is really the reference rate for all other bond markets in the world, especially Latin America. So this is our forecast versus the other economists in the Wall Street Journal, right? Because I always think if you're listening to an economist, you want to know, like, are you with consensus? Do you have a different view? Why do you have a different view? So we have a somewhat different view. We think the Fed is going to cut 4 times this year. Now that may bleed over into the first quarter of next year. The point is, we think there are going to be 4 rate cuts. We think that the Fed is going to stop there. So if you look at the other lowest 5 respondents from the Wall Street Journal, we are in line with them. However, our view is different in that we think the neutral rate is about 3.5, right? So we're going to cut and then we're going to stop. And the part of the reason we think we're going to stop is we think the Fed has a lot of ammunition with regard to the money multiplier in the U.S., right? This isn't a U.S. presentation, but just to say, right, we know housing is stuck. these 4 rate cuts would help keep the yield curve steep, and that would help housing. It would lower the premium of mortgage rates over 10 years, and that unlocks a whole lot of mortgage equity and economic activity. So we don't think they're going to need to do more than 4. Likewise, we think that the unemployment rate is going to fall a little bit below the median, but not as low as the other lowest forecasters. And that's in part because we think that inflation, while it's ticking up at the moment, is going to do what it did the last several years. It's going to drift down throughout the year. Again, as housing becomes more and more unstuck, that is a big source of services inflation in the US, so we're going to see that moderate a bit. We do think goods inflation is probably going to trickle up to the extent that we apply tariffs, but we also think that there's a lot of room for negotiation. So that's just to set the stage on our US forecast and how that underpins some of what's going on in Latin America. One potential wild card and reason why we could be wrong, right, is because right now, although inflation expectations are down, it's a very different situation than the last time we had tariffs, right? The last time we had tariffs, inflation expectations were very low. They were targeted on specific goods, and so countries and companies were able to elongate their supply chain. We know some of that supply chain elongation occurred in Mexico, right? So we've seen a big increase in our imports from Mexico while our imports from China have gone down. Likewise for Vietnam, but again, this is a Latin American focused presentation. So we were able to keep inflation low in the face of the last tariffs, even though they caused slight price increases. This 10% tariff across the board on China and China's retaliation comes at a time when we have recently had higher inflation. So let me ask you guys a question. Did anybody between, say, end of October or the election and now buy any like appliances, cars, durable goods? Anybody buy any durable goods because you thought, well, you know what? I am planning to buy this, but let me buy it now in case the price goes up. Did anybody do that? Nobody? Really? Okay, you guys are the first audience where I've had literally nobody raise their hands. Okay, well, I'm going to call that inflation expectations in Miami are anchored despite those egg prices. But usually when I've asked this question over the last month, I have about 25% of people raise their hands and say, yeah, you know what I did? I did buy, I personally bought a washer dryer. We were planning to buy a new washer dryer. Wasn't urgent. I was like, let's just get that done in case prices rise. But that's the thing about inflation expectations, right? If you expect prices to go up and you bring forward consumption, what you do is you're increasing demand, which then is a self-fulfilling prophecy where it puts upward pressure on prices. Okay, so this is the wrinkle. This is where we could be wrong in our forecast. So I give our forecast with about a 60% certainty as a baseline. There's a lot of stuff happening in the world that could cause it to be wrong. So going to Latin America, right? Latin America, a few things to note, right? They had inflation that ran up like everywhere else in the world, right? We know inflation went up globally as a result of the pandemic, the supply chain shortages, the fact that people were not out consuming services, so we had an excess savings build up everywhere in the world. So regardless of what the government policies were, we had an increase in prices, right? Latin America was no different. It's just that Latin American central banks have seen this movie before, right? They've seen inflation before. So guess what they did? They raised rates ahead of the Fed, 6 to 8 months ahead of the Fed. And you could say that they possibly did a better job, right, by getting ahead of some of this inflation. And so as a result, they are ahead of the Fed with regard to cutting rates. And now they're mostly done. We expect a couple more rate cuts in Latin America, not a significant number. And what you can see is inflation is our forecast is for inflation to fall in most all economies. In fact, there's not a single economy where we expect inflation to be higher in 2025. Likewise, though, well, no, Okay, that's the 6-month annualized, but if you look at the year over year, it's 117 down to 39, right? So when we look at the 3 and 6 month annualized to see if there's anything in the trend that we should be aware of. Now, if we look at Argentina, let's just stay with Argentina for a minute. 5.8% growth, really impressive. Anyone know what the high watermark was? Right, what the highest level of GDP was when that date was for Argentina? Anyone want to guess? Well, that's a very pessimistic guess. Anybody want to be a little more optimistic? It was Q4 2017, right? So we're still below Q4 2017 levels. So we're going to need a couple more years of this really strong growth in order to get back above that high watermark and start having per capita GDP improve. And we'll get into that a little later on how Argentina's doing. Brazil, slower growth. Mexico, really not a great outlook. I think Mexico probably has the most upside. Look at Chile. Chile's sort of steady Eddie, but an economy growing at 2.2% really shouldn't have this 4% inflation. So I would say that Latin America's challenge overall is this somewhat stagflationary environment, right? Really slow growth, still persistently high inflation. And some of that's currency pass-through. That currency pass-through is not going to improve, right, if Trump proceeds with tariffs, because it's going to, on balance, strengthen the dollar. So some challenging times for Latin America. If we look at the official policy rates are still pretty high, right? Latest, 13% in Brazil, 10% in Mexico, 5% in Chile, 32% in Argentina, right? We do expect some room, again, for some rate cuts next year. I would say the risk is that we have fewer rate cuts than we are forecasting, right? And that the 10-year yields moderate a little bit, but again, not as much as you might think. And of course, this all depends on what happens with the US and our 10-year reference rate. All right. Looking at some more infrastructure, foreign direct investment, it's actually quite a positive story in Latin America. So we'll start with Brazil and Mexico, the two largest economies. And what we're looking at here, that blue line is the foreign direct investment. The red line comes from the EIU's Business Operation Index, right, our Operational Risk Index. And so the red is financial risk, and the gray is infrastructure risk. These are two sub-indices that go into this operational risk index. And what you can see, unsurprisingly, is that they correspond to higher FDI, right? When these subcomponents are rising, FDI is on the upswing, and it's on the upswing because the governments are doing things that make these places better places to park your long-term capital. So you see that with Brazil and Mexico. Mexico, some of that was China. So we're seeing a little pullback. But again, I think Scheinbaum, in my opinion, has really outperformed my expectations so far. So I think there's a lot more upside in Mexico than our baseline forecast might suggest. Looking at Chile and Colombia, very similar story, right? You're seeing improving infrastructure risk, improving financial risk. Chile was steady all along, right? So we're seeing a higher level, and so if you look at the right-hand y-axis here, right, you can see Chile is on a very different scale than Brazil, and that's why it doesn't really need to continue improving. It's already in a really good place. Okay, moving on to Peru and Argentina. The FDI data is a little delayed from Peru, but given what's going on with financial risk, I would expect that to continue rising, right? Argentina has had a surge of speculative capital in both its publicly traded capital markets and in its FDI. Of course, it's going to be getting more money from the IMF. That's going to lead to some inflows. And Milei's challenge is to just kind of keep everybody believing in this experiment long enough to see if it can actually deliver long-term results. Okay, we created an index called the Trump Risk Index. And we graded it on 3 things. We graded it on trade. So if you have a large trade deficit with the US, you're a little bit more vulnerable. If you have a lot of immigration, a lot of your citizens are here in the US, and here what we did is we used remittances, right? So that's a really good indication, other than official statistics, with regard to how many people are here, how much are they earning, and how much are they sending home. And then we use security. So for example, Costa Rica does not have its own military. It relies 100% on the US. Now there are a number of US citizens who are in Costa Rica. It's a very popular place to go on vacation, to buy a retirement home. So I think it will be difficult politically to remove that security, but it does place it at a higher risk. So Mexico, unsurprisingly, is not only the #1 at risk in Latin America, it is the #1 at risk in the world, right? Based on these 3 factors. And then you go along, and actually many places in the rest of Latin America are not actually that vulnerable. But what is vulnerable is the drug trade, right? So you look at these IEPA. IEPA is the law. It's under which the president issued the executive order, really ripping up the North America, or whatever, the USMCA. And so you can see that drugs come up through South America, through Mexico, into North America. This is cocaine only, right? But it's an interesting proxy for other drugs. And of course, you can see that higher cocaine production is linked to a higher homicide rate, right? Because you have more drug action, drug violence. And so, this IEPA rule is a national security rule. And it is something that I think it's not just about the border with the United States, right? But if Mexico is going to solve this problem, they're going to have to deal with their southern border and all of the shipping routes by which these drugs enter Mexico and are transited on into the United States. Now, retreat from the United States does open the door for China. So how many people are familiar with China's Belt and Road Initiative? Yep, okay, we have some hands going up. China's Belt and Road Initiative is really their version of USAID, right? We call it aid, they call it financing. Either way, it's the same thing. It's being involved in the commerce of other countries so that you can influence them, so that you can curry favor with them, so that you can get them to agree to other deals with you, and so that the impression of your country around the world is elevated, right? And so what you see here is that the blue countries are ones where there are official Belt and Road initiatives, and although there is not an official Belt and Road initiative with Brazil, Brazil has $1.5 billion invested. Other largest investment would be in Chile, right? But that otherwise, those are really big investments, right? Like so. You see some of these in the hundreds of millions, but really, really significant, $15 billion in Mexico, not a Belt and Road country. So really using their influence to gain access to raw materials, to sell their products into these countries, right? Because that's really important. A lot of US companies sell products into foreign countries. Interesting fact. US companies operating in China make more in annual revenues than our trade deficit with China. All right, I'm going to say that again. US companies operating in China make almost 2 times in annual revenues what our trade deficit is with China. Right? So these are complicated relationships. If we look, China is now the region's dominant trading partner. So share of Latin America, excluding Mexico, because there's so much intertwined between the US and Mexico, right? So excluding Mexico, China has exceeded the US in terms of being the largest trading partner in terms of percent of total trade. That's two-way trade. Most Latin American countries do rely on the US, though, as a primary export market. So again, this is not to the right-hand graph, two-way trade, imports and exports. left-hand graph, exports only, right? So you see Mexico, share of exports, 83, far outweighs the others, right? And then we have Colombia at 28, Chile at 16, Argentina is the least at 8%. But depending upon how things go in Argentina's economy, we could see that growing and changing. Then we look at energy transition. It drives critical mineral value. We know there's a lot of critical minerals. We know that China is leading on EVs, so now EV sales in China far exceed internal combustion engine vehicles. And we see them selling BYDs. Anybody ridden in a BYD vehicle? Yep, I've ridden in one in China. I was just in Dubai. Yeah, they're actually, I'm interested to admit, very nice. Like they're I would say I'd put them on par with like a Lexus, right? So same kind of quality. So they are very involved in Latin America in part because of these critical minerals. And then I think that wraps it up, just sort of talking about this changing geopolitics, changing nature of these economies, and really changing influence from these two superpowers in the world, the US and China. Really, we see that displayed pretty prominently in our own backyard in Latin America. So, I can use this microphone, and we can use this one to pass around, if that's better.
Yes, thank you so much. Thanks so much. I know that with microphones, the right microphone at the right time is so important. Okay, we're back on. So you have really touched on a number of real, I'll call them meta issues that are now dominating the headlines. We have obviously inflation, and there are just to sort of group them in three areas, and please feel free to comment. It seems there's the transaction costs of inflation, which are driven by a number of factors, resources, macroeconomic policies. Then there is obviously the security component, the Trump component, which is tied to border security and obviously the drug trade, fentanyl being one. We had cocaine, but fentanyl is part of that. And then finally, we're looking at really sort of the race for resources, not just talent, but resources, minerals, access to markets, that really echo a lot of the issues that our prior speaker, Amity Schlase, was talking about.
Yeah.
In the next 2 years, what do you generally see in the region? If I'm an investor, if I'm running a fund or I'm running a multinational, what are sort of the meta issues that you really need to focus on as an investor, but also as a leader?
Yeah. So obviously, this drug issue is a problem, right? And like anyone who supplies a product will tell you, part of the supply of your product depends on the demand for your product, right? So this is a two-pronged issue. The demand issue is something that and when I say we, I mean humans. I don't really mean the US or Latin Americans, right? Like humans have always had difficulty preventing demand, right? There's the crux of the opium wars. China couldn't prevent demand for opium. People had it, right? So I don't want to say that's an unsolvable problem, but for hundreds of years, we've really never been able to solve that problem. So then you have to look at the other side of the problem, which is the prevention of access. And again, that is something that has been tried for a number of substances over the decades, right? With minimal success. So now we're dealing with, okay, let's increase our border security, right? And this may work. I will say that these episodes increase and then they wane, but you should know that like the origin of the fentanyl is not Latin America, right? This is a business. There's pharmaceutical labs producing this in China, right? This gets produced like any other drug and sent, right? So you have to there are multi-pronged ways to address this. Now the fear is that if you if you agree, you get China to agree, and they actually shut down these facilities in China, the question is, where will they spring up? It's very much a game of whack-a-mole, right? So while I think this is critically important, it's also, we have to realize that this is a centuries-long pernicious problem.
Right, and so obviously, the security issue is now dominating the conversation on trade across the Americas, which it hasn't really been since really the Cold War, since really the 1970s, where U.S. sort of Cold War strategy dictated our trade policy. If I am a U.S. consumer, if I am an SME, middle market person, if I am a bank and I am trying to deal with the disruptive nature of not just inflation per se, but of these rising transaction costs that are driven not just by the amount of money in the economy, but the aggregate costs. What do I need to look out for?
I'll tell you what the opportunity is. Has anybody heard of factory twinning? Oh, this is good. Okay. Factory twinning is a phenomenon that's enabled by the chips that have been developed in the course of building out artificial intelligence. So what happens now is, let's say you're Siemens, right? And it's a huge manufacturing company. They take their most productive factory, and then they literally build an exact twin of it somewhere else in the world. And they use the data from the most productive factory to inform how they're producing, right? This combines with things like robotics and 3D printing. So the capacity to move your supply chain now, even for the most complex processes, has been turbocharged in a pretty astounding way. So if you're thinking about investment opportunities and you're thinking about the proximity of Latin America, right? And you were to use, for example, some of our business operational risk data, not to do a shameless plug, but it is really quite useful to ascertain between countries where might you want to be located, right? And you can do this factory twinning. There's a huge opportunity for, I think, Latin America to really gain a huge amount of manufacturing share for the world economy.
And that's a great point. And so I'm going to have to ask you on that. During COVID, obviously, the conversation of home shoring was a conversation that
and
had...
friendshoring.
And friendshoring. So you have, Florida and Texas benefited. Other economies, such as Tennessee, benefited from home shoring. Obviously, within North America, there are sections and regions that benefit. But for Latin America, if I were a company and I wanted to leave China, and I wanted to leave some of these other places, and my main market was the United States. Within the Americas, right now, where do you think is the best place to be?
Okay, so Chile, it has the lowest numbers, right? Which means the higher score means more risk, right? Chile is probably your number one bet for if you were going to do factory twinning in the region.
Right, and shipping right up the Pacific to California.
Yep.
Right, okay.
We can look at some of the other
Yeah,
numbers.
no, please.
Yep. Okay, so, but you can see on that right-hand side, that y-axis on the right-hand side, while Brazil is much bigger and Mexico is much bigger, higher risk, right, than Chile,
Right.
where we have a very low level of risk.
Right.
Higher still in Argentina, obviously. Peru is getting better, right? Certainly on its financial risk, it could probably improve its operational risk, right? So we go
Right.
back to Chile.
Right.
Oh, sorry, skipped it. Actually, it's not that different than Chile right there.
Right, so Peru is an opportunity.
Yeah.
Okay.
Peru and Chile, I think, are your best opportunities there.
What about Colombia? Because Colombia obviously is just north. It has access to both the Caribbean and the Pacific.
I am remiss in not including Colombia here. Oh, no, I have Colombia, right? Still high numbers, though. Still high numbers. Improving on an upward trend, right? Certainly in terms of its infrastructure and financial risk. But I think it's worth delving deeper into what's happening in Colombia. And by the way, that doesn't mean you don't invest. It just means you need an ROI that pays you for that risk.
Right.
Right?
And is that driven by the current political administration, the Petro administration? Is that really what's driving these numbers?
No, these go back much longer, right? So this goes back to 2006. Okay. So a lot of these institutional changes span multiple administrations.
Right. So we sort of see a trend. There's a sort of a Pacific theme here. You have Chile, Peru, obviously Colombia. What about Ecuador? Just to sort of.
Yeah, I mean, I don't have Ecuador on here.
Smaller economy.
Much smaller economy, much different type of infrastructure, much different type of labor market.
Right. And in terms of Central America, is the market so small, or you see anything in the Caribbean that impacts some of these economies or supply chains?
I did not look at that detailed data, but certainly if you are interested, we can get back to you on that.
Well, I look forward next year another presentation. This has been phenomenal. So I guess the question that people in Miami have, because obviously we are really the financial services hub for the region.
Yeah, there's a lot of money here from Latin America.
I think that's a net positive for everyone here. We have heard a great deal, obviously, about Milei. You've mentioned Chile. Obviously, Chile had an approach to economics that is far different than many of its neighbors, and it has reaped the benefits of that. Milei's approach seems to be very much aligned with a far more neoclassical approach to economics, or Austrian school approach to economics. What do you think is sort of the trajectory of Argentina? And I'll be mischievous and I'll say, compared to Brazil, because we have Brazil and then we have Argentina, and they are run by two very different administrations with very different philosophies. What are you seeing there in terms of those opportunities?
Well, they're also very different economies in terms of their economic structure, right? Both of them have fairly highly educated population. Argentina, historically, much higher education levels. Per capita GDP is higher in Brazil, though, and has been for a long time, right? So while it's got more frictions, it's bigger, and it actually operates better for more people despite those frictions, right? On the other hand, I feel like Argentina is one of those countries. So Dostoevsky, the Russian writer, said about Turkey that Turkey would always be the country of the future, right? I think that that's still true. He was very prescient. I feel the same way about Argentina, right? Okay. Argentina will always be the country of the future. Now, if it can break through that and actually get there, that would be really quite something. And part of that depends on these congressional elections that are coming up later this year. But I think Milei is right about a number of things, right? For example, he gives if you haven't listened to his YouTube on why tariffs are really not productive policy, it's probably worth a listen. Now, we have started to use tariffs as part of a security tool. And I honestly don't think in our case, especially with regard to China, we had much of a choice, right? Like it's hard to imagine any other tool given the situation that we could have applied, right? But let's not conflate that with relations with other countries.
Right, right. So for Argentina right now, it looks like they're going through a period of sort of bringing the currency back to a value that's sustainable and that's real, and dealing with some of the legacy issues and the transaction costs of that. So in the next 2 years, if you were looking at FTI, what countries to go, what would be your top three?
Chile, Peru, Colombia.
Wow.
It's not that I wouldn't go to Argentina, it's just you're taking a lot more risk. You have to realize that you have the risk, like, I think it's a little early. On the other hand, I also believe in risk taking, right? So would I invest in Argentina's stock market? Yeah, sure.
Right.
Right? Sure. But FDI, obviously other people though are investing, and we've got the new IMF money. So it'll really depend on what happens with their current account. right? And that current account, and then I would obviously also watch that gap between the official exchange rate and the black market exchange rate.
Right. So we're coming up to time. I just want to open the floor up for the remaining 5 minutes for any questions that may have.
There's a microphone on that side right there.
Thank you, Mrs. Hunter. Thank you so much for your comments. Can you guys hear me?
Yep. I can repeat the question.
Thank you for your presentation. Very insightful. Two questions, though. One regarding Mexico. So last year at the same conference, there was a lot of talk about the possibilities or the promises of nearshoring. All of a sudden, we don't hear a whole lot about that. Has that dissipated? Also, regarding Argentina, I saw you have a 5.8% forecast for 2025. That's very impressive. What specifically, brought you so the forecast so high? Was it fiscal consolidation? Was it a comparison base or a combination of both? Thank you.
So they're both easy questions to answer. So what ended the idea of friendshoring with Mexico was ripping up a treaty that we have with them, the USMCA, and threatening to impose 25% tariffs. That can also go away instantly if we wanted to. And then with regard to Argentina, it is base effect, right? So you've had 2 years of declining GDP. And so as a result, now you're having a little bit of a bounce back from that very, very big decline you've seen over the last 2 years.
Hello, Constance Hunter. Thank you for your presentation. It was very insightful. I wanted to ask, why do you think the U.S. paints trade deficit with China in such a bad light when overall we benefit from trade?
So that's a great question, and we do benefit from trade. And let's not forget what the flip side of our trade deficit is, right? So that's a trade deficit is called a current account deficit. The flip side of that is what? Does anybody know? A financial account surplus, right? So we are the reserve currency. If you are the reserve currency, you must have trade deficits because you must have financial account surpluses on the other side. It's an accounting identity, right? And we benefit a great deal from the fact that we are the largest recipient of FDI in the world. People bring in not only dollars to invest in physical assets, but they invest in our treasuries, they invest in our equity markets, they invest in corporate fixed income, they invest in all manner of financial services products, right? And we see that displayed here in Miami, right? Very, very, very consistently, probably as much, if not more, than any other city in the US. The thing with China is that when we brought them into the WTO, there was this perhaps arrogant assumption that they would then converge to our way of doing things in terms of openness, in terms of information, in terms of regulation, right? So some of our regulations are a little overdone, but some of them are really important to make us a place where people want to invest their money. And so what happened is China didn't really converge in the ways that we anticipated. In addition, because so many of their companies are still owned by parts of the state. So you might have 20% free float, 30% free float of a publicly traded company, but the remainder is owned by the government and really used to build up a military-industrial complex. So when you look at the official data on how much China spends on its military, that's probably undercounted by about 40 to 50%, right? So because it's hidden in these so-called companies, which are traded but not public, right? And so what's interesting is automobiles, which obviously is this huge global supply chain, is now at the crosshairs of this because automobiles have become computers, right? Like we started with GPS, then we went to like driver assistance. I don't have my phone, you said me my phone, I can pull up my phone and tell you exactly where my car is, right? At any minute.
Absolutely.
You have all sorts of computer systems in there. And so it has it has now become, technology has become entwined with security risk. And so that's why we've seen this merger of security policy and trade policy. And by the way, it started with the Trump administration. It's completely bipartisan. The Biden administration, Biden issued an executive order that strengthened Trump's initial executive order on tariffs, and then his Commerce Department implemented ITCS, I think I have that right, which is a whole set of rules around automobile parts trade that was finalized in December, went into effect Tuesday of this week, right? But so this is something that is now has a through line across party lines because this type of threat that China poses is so unique and different to anything we've really faced in the past.
So are there any concluding questions? Because I have one that sort of touches on some of the points you brought up. You raised security. We raised transaction costs. We raised Chinese FDI, threats, challenges, opportunities. We obviously are the Chinese economy clearly affects not only Latin America, but it clearly affects the US market, though not necessarily directly. And as you mentioned, obviously China's control of its currency, control of valuations, control of information, their economy does not operate in the way that a more transparent economy would, with prices, controls, and currency valuations. What do you expect to see in the next year or so as this realignment occurs and the United States begins to hold China accountable and it begins to alter the incentives on supply chains?
So this ICTS implementation is huge, right? That Biden pushed through in the Commerce Department, and it's going to change the auto supply chain, which has become global. So I think at first, the frictions and especially if we keep tariffs on Mexico and Canada, which I personally don't think we should do at this time, especially given it's colliding with what's happening with ICTS implementation. So that would cause higher prices for autos. But eventually, right, what we saw during the pandemic was despite the frictions, despite the price increases, incredible resilience in the global supply chain, right? We saw an elongation of supply chains. Now, of course, we have a country of origin rule within the ICTS, right? So China cannot just make it in China, transport it to Vietnam, slap on a made in Vietnam sticker and import it, right? They have to be Vietnamese companies.
Right.
Right?
And they've tried to do that with Mexico, obviously, yes.
Right. This is going to be, I think this is going to be incremental when we look back on it, even though it will feel like it's more than incremental while it's happening. And some of it depends on what happens, like how much we can cooperate with our major trading partners. How much can we cooperate with Latin America on this? How much can we cooperate with Europe on this? That cooperation shouldn't be discounted. It's really, we're powerful on our own, right? But we're more powerful when we cooperate. So I would say, if I want to gum with one concluding remark, look at all of us cooperating here today. We know that humans' greatest gift is our ability to put our minds together and to think together, to make the whole greater than the sum of the parts. Here we are coming together in person today, cooperating. That's where the magic happens.
Well, on that note, thank you so much for this wonderful presentation and for your time.